There's a certain type of trade that I love to take when volatility gets up, and I wanted to share with you in this video what is this type of trade that I love to take when volatility gets up, what is the strategy, what is the rationale behind it, what are my results, so hopefully you can use it in your own trading for yourself. But before diving into this video, if you find this video interesting or helpful and you actually learn something in this video, please consider subscribing to my channel. It's free and it helps me a ton, you can't imagine. As you can see in the title of the video, I love trading VIX futures. However, even before talking about the strategy itself, what type of trade I love to take, we need to understand what is the VIX in the first place. The VIX is the implied volatility for the S&P 500 for the next 30 days. If you see that the VIX is around 20, then we expect the S&P 500 to move by 20% over the next 30 days, either 20% up or 20% down. The VIX is often referred as the fear index. We call that the fear index because in general, when the market crashes, you will see that the VIX will tend to go up. And the higher the VIX, the higher the fear in the market. That's why we call that the fear index. And in general, for investors, for portfolio managers, or even traders, they tend to allocate more or less capital into the markets based on how high or how low is the VIX. Because usually the higher the VIX, the more expensive the premiums are for the overall market. Meaning that, for example, for option sellers, if there is a very high VIX, then you can expect to have very expensive premiums for the overall markets. And the lower the VIX, the lower the premium, the cheaper the premium for the overall market. One particularity about the VIX is that it really have this correlation between a market crash and the VIX going up. And right now you can see the S&P 500 and we've put the VIX at the same time on it. And you can see that whenever the market crashes, you can see that the VIX is going up very quickly too. When the market usually crashes, you're going to see that the VIX tends to go up very quickly too. And you really have this opposite correlation. The more the market is crashing down, the more the VIX is going to crash up. And usually when the market comes back up very slowly, then you're going to see the VIX coming back down very slowly too. And you can really see that correlation over and over. For example, in the 2000 crash, you see that the market is crashing down very quickly, and you see that the VIX is crashing up very quickly too. Same in 2007, same in 2020, and even in between those very big crashes, whenever the market goes down a bit quickly, you will see that the VIX is going to go up a bit quickly too. And that's really the particularity of long volatility products. They tend to crash up, and that's probably the only products that tend to crash up, because usually we don't see the market crash up, we see the market crashes down, and it tends to really climb up quite slowly compared to volatility products and long volatility products that are going to crash up very quickly and then go down very slowly, following the climb up of the market that is very slow too. But as I said, even the 2007 crash and the 2020 crash, you don't even need a crash to see the VIX going up. You can see that in between there has been several instances where the VIX went up very quickly when the market went down a bit. But why am I even talking about this? Why is it even important to talk about the VIX going up or going down? And you see that whenever it goes up, it's only brief moments in time when it actually goes up. It never sustains a level. For example, it never stays at the 80 level. It always goes back to a level that is around the 20 level, or for example even below. And if we talk in probabilities, when you see the VIX going up, there is very low probabilities that the VIX is going to rise even more. And it's only during very rare crashes like the 2007 crash or the 2020 crash that the VIX is actually going to go that high. But even when it goes that high, usually it goes down very quickly and it goes back to that mean very quickly. And because we know that the VIX never sustained this type of high level, or at least historically from what we know, it has never been sustaining any high level. For example, you've never seen the VIX staying at 80 for like 6 months. It's always been maybe topping the 80 level for like 1 or 2 days, and then it went back down directly. And if we find a way to short the VIX when it actually gets high, this is a very high probability trade, meaning that we have a lot of chances to actually be right on that trade, knowing that the VIX never sustained this type of trade. But we cannot trade the VIX itself. It's like the S&P 500. We cannot trade the S&P 500 as such. We always trade, for example, either the SPY, which is the ETF, or for example, the SPX. And that's the same thing with the VIX. We can trade the VIX futures, but we cannot trade the VIX itself. So in theory, if we manage to, for example, short the VIX futures, then we are able to bet that the VIX is going to go down whenever it gets that high. And that's really the theory of the strategy that I love to take whenever the VIX gets high. It's really shorting the VIX futures whenever the VIX gets high, because there are very high probabilities that the VIX is going to go back down to a mean. And that's really the type of trade that I take over and over. Whenever the VIX gets high, I'm going to short VIX futures, knowing that the VIX never sustained this type of levels. And most of the time, the VIX goes back to those levels that are around the 20 level level or the 15 level like we've seen historically. And personally, what I do when I see that the VIX is going up around the 30-40 level, I know that as there is a very strong chance that the VIX is going to go back down, I'm going to sell a call credit spread on the VIX futures, knowing that I have a very strong probability of being right on that trade. By selling call credit spreads on VIX futures whenever the VIX gets high, I'm going to take a short position, meaning that I'm betting that the VIX is going to go down. And I'm sure that now you can start understanding why this is such a great strategy to use, because as we've seen historically that the VIX never sustained those high levels, then it's almost like a free money that you're being given to, because the VIX never sustained this type of level. So why not taking advantage of the VIX whenever it's high? And of course, I need to balance my statement here. Does that mean that I'm always right whenever the VIX goes up? No, of course, because the VIX could always go even higher. But for example, whenever the VIX goes around 30-40 level, you know that it only has a very slim chance of only going higher. So the higher the VIX, the higher the probability of actually seeing the VIX going back down. Let me show you, because right now the VIX is around the 30 level, so this is really a perfect example of what you can do on the VIX right now when it's actually that high. As you can see right now, the VIX is around the 31 level, which is quite high if we look at what happened historically. And what I personally do is that I would sell, as I said, a call credit spread on VIX futures. And with the TastyWorks platform, you can really just go on the VIX and sell call credit spread like this, as if you were trading the VIX directly. So what I would do personally is that I would start selling a call credit spread on the VIX. And if you've been watching some videos that I've been doing on call credit spreads or on credit spreads in general, you know that I have this technique that I love to use, which is the 1/3 of the width of the strike rule. Meaning that whenever I sell a call credit spread or a put credit spread, I like to collect 1/3 of the width of the strike as a credit collected. Meaning that if I sell a call credit spread that has a width of the strike of 1, then I'm going to try to aim to collect 33 cents as a credit. And let's take an example here so it's completely clear. So personally, what I would do is that I would probably sell the 29 strike and buy the 30 strike. And one particularity directly is that you see that those are strikes that are in the money currently. Well, it's because if you go too out the money on the VIX, then you're not going to collect as much credit as if you were, for example, going to the 29 and 30 strike. You see that right now, I'm collecting a credit of 35 cents, making a profit of $35 if I'm right on the trade. And if I try to go more out the money, I'm not going to collect as much credit for the width of the strike. For example, if I move to the 32.5 and 35 strike, as I'm having right now a width of the strike of 2.5, and I would like to collect 1/3 of the width of the strike as a credit, so as to make sure that the risk is actually worth taking, then I would need to collect around 82 cents of credit. And here you see that I'm collecting 60 cents as a credit. And you see that it's not really the target that I like to receive in terms of credit, so it's not really worth taking for me in terms of risk. And I'd rather go, for example, for strikes that are a bit more in the money, and I don't really mind because there is enough extrinsic value left so as not to fear of being assigned whatsoever. And still, you see here that I have a width of the strike of $1 and I'm collecting 35 cents. And if I was following my rule of 1/3 of the width of the strike for the width of the strike of $1, then I would aim to collect 33 cents. And here I'm at 35 cents. So it's above 33 cents. So it's completely cool. And I know that by selling a call credit spread, by selling the 29 and buying the 30 strike, I have very high probability of seeing the VIX going back down, for example, around the 20 level. And this is really a high probability trade that I love to take whenever the VIX gets a bit high. After that, nothing prevents you from going further at the money or maybe increasing the width of the strike if you're completely fine with it and putting a stop loss if you want to. Personally, I'd rather stick to, for example, the 1/3 of the width of the strike rule, which really ensures me that the risk is actually worth taking. But this is really my way of trading, and personally, it's been working well for me doing this type of trade. You see that I've chosen in that case the February 17th expiration, which expires in 15 days. And you really could choose, for example, a later expiration if you want to have more time to be right. And it's completely right if you want to choose a later expiration that has around, for example, 40-45 days to expiration. Because you know anyway that the VIX is going to go back down to those levels, and there's very low probabilities of seeing the VIX even going higher. Absolutely completely up to you to choose which expiration you like to do. Personally, I like to stick to expirations that are around 30 days to expiration, 35 days to expiration. I think it's really a good middle ground. And this type of trade really has been working well for me. Whenever the VIX would go up, for example, to the 30-40 level, I would sell a call credit spread, trying to collect 1/3 of the width of the strike with an expiration of around 30 days. And most of the time, it's actually right because historically, the VIX has always been going back down to the mean, to this type of level around the 20 level, 15 level. So it's really a great high probability trade that I love to take whenever the VIX gets high. Which leads me to talk about when to use really this strategy. As you have understood, this strategy is to be used whenever the VIX gets high. But you see that it's not always that the VIX is going to the 30, 40 level. So it's really a strategy to keep in the back of your mind that I personally love to use. And whenever the opportunity actually arises, I'm going to use this strategy. Otherwise, I'm really not going to use it at all. And for example, in 2020, I've probably been using it like a couple of times, but it's actually been useful. I remember that, for example, in June, we've seen the VIX rise also in September. And whenever, like every 2-3 months, whenever the VIX actually rise a bit to the 30-40 level, this is really a great opportunity to take advantage of the volatility in the markets. And whenever the VIX is down, I just sit on my hands and keep that strategy in the back of my mind, ready to be used whenever the VIX will rise. I hope this video made sense about how you can take advantage of the VIX whenever it gets high and why it's such a high probability trade. If you've got any question about the strategy, or for example, which expiration, which strike should you choose, don't hesitate to comment it below. I'll be happy to help if you have any question. Please make good and informed decisions. I'll see you in the next video, and in the meantime, I wish you all the best.